Over the past 3 weeks, US stocks, as measured by the S&P 500, have experienced a correction defined as a 10% fall in prices from their peak. Unpredictable US tariff policy, retaliation by trade partners, and falling consumer confidence have spooked investors, raising worries about a potential US recession. While we think the uncertainty increases recession risk, we expect growth of the resilient US economy to only slow rather than crumble. Let's take a closer look. With uncertain trade policy and large-scale layoffs of federal workers, US business and consumer sentiment surveys have weakened, and analysts are starting to downgrade corporate earnings estimates. A large body of research suggests that trade policy uncertainty historically has delayed investment, potentially causing a slowdown in economic activity. Federal worker layoffs can also spill over to the private sector as ancillary contracts are cancelled, affecting economic activity. These developments have led to investors turning bearish on US stocks and a sell-off in higher beta equities, along with a rally in Treasury yields. Is this a growth slowdown or a recession? The developments so far do not suggest a recession, but growth estimates for 2025 are falling. The US economy entered the year strong, and forecasts still point to growth in the range of 1.5% to 2%. Meanwhile, the labor market is in a decent spot, with an average of 200,000 jobs added in the past 3 months, while wages adjusted for inflation have grown to post-COVID highs. And we expect the Federal Reserve to continue to ease monetary policy, providing more economic support. To be clear, we believe that there is greater uncertainty around our baseline of slowing but positive growth. Prolonged policy uncertainty could weigh on investor sentiment in the coming months. To find more clarity, we think investors will focus on trade, immigration, and tax and spending policies from the new administration and the Fed's response to the changing policy backdrop.